Hedge fund investor Ray Dalio is known for his emphasis on the importance of understanding economic cycles and how they influence market conditions. Dalio often advises investors to remain properly diversified during times of uncertainty. It can be argued that we are currently living at a very uncertain time when many circumstances that could impact the markets negatively are forming. Dalio specifically has been warning about the increasing levels of debt and money printing that has been going on for a while now. In today's video, we are going to take a look at Ray Dalio's all-weather portfolio. Dalio's philosophy behind the all-weather portfolio is to build a diversified portfolio that can withstand all market conditions. In order to do that, Dalio seeks to incorporate as many uncorrelated assets in the portfolio as possible, so that if one asset goes down, another one goes up. The goal of the all-weather portfolio is to reduce volatility and reduce losses during market crashes, in addition to providing a steady return over the entire lifetime of the portfolio. Now let's go over Dalio's all-weather portfolio and see what assets he chooses to incorporate in it. The portfolio has a 30% allocation to US stocks. This can be done through buying something like the Vanguard Total Stock Market ETF VTI. VTI seeks to track the performance of the entire US stock market. It's diversified across growth and value stocks and includes large, mid, and small cap equities. The fund holds 3,513 different stocks. Historically, the fund has performed very well. Just in the last 10 years, the fund has gone up by 172%. Next, the all-weather portfolio has a 40% allocation to long-term bonds. This can be done through buying something like the iShares 20+ years Treasury Bond ETF TLT. TLT seeks to track the performance of US Treasury bonds with remaining maturities greater than 20 years. Long-term US bonds provide a guaranteed stream of interest income. Additionally, they are considered a safe haven asset, and thus they tend to go up during market crashes. Historically, TLT has performed well. Just in the last 10 years, the fund has gone up by 82%. Next, the all-weather portfolio has a 15% allocation to intermediate bonds. This can be done through buying something like the iShares 3 to 7 year Treasury Bond ETF IEI. IEI seeks to track the performance of US Treasury bonds with remaining maturities between 3 and 7 years. If we look at a chart of IEI past performance, we can see that it has not performed as great as VTI or TLT, but it has been less volatile. So owning IEI will serve to reduce the volatility of the portfolio while providing a guaranteed stream of interest income. Next, Ray's portfolio has a 7.5% allocation to gold. This can be done through the Spider Gold Trust GLD. GLD tracks the gold spot price using gold bars held in London vaults. Dalio chooses to own gold as an insurance asset against inflation and currency debasement through money printing. Here is what Dalio once said when asked about gold. "I think that the investments that will most likely do best will be those that do well when the value of money is being depreciated and domestic and international conflicts are significant, such as gold. Finally, Dalio's portfolio has a 7.5% allocation to commodities. This can be done through the iShares S&P GSCI Commodity Indexed Trust GSG. GSG is a trust that tracks a pool of commodities, including oil and natural gas, in addition to some exposure to meats and livestock. Historically, the fund has performed terribly due to the low inflation environment that we have been living in for the past decade. However, Dalio knows that if we transition into a period of high inflation, where prices of supermarket goods increase, then something like GSG will do very well. Looking back at the chart, we can see how that happened between 2007 to 2008. Now, let's look at the overall performance of Ray's all-weather portfolio. During the past 10 years, the portfolio has averaged an annualized return of 7.53%. The S&P 500, on the other hand, has returned an average of 11.59% annually over the same period of time. Clearly, in the past 10 years, the all-weather portfolio has lagged behind the S&P 500. Now, let's look at the downside risk. For the all-weather portfolio, the maximum drawdown happened during the financial crisis of 2008. At that time, Ray's portfolio went down by 12.19%. On the other hand, the S&P 500 went down by 56% during the same period of time. Thus, the all-weather portfolio succeeded in doing what it is supposed to do, that is, reduce volatility and downside risk. In March of 2020, the S&P 500 went down by 33%, while Ray's portfolio went down by only 2.34%. So, once again, the all-weather portfolio outperforms the general stock market during a crash. As we can all see, Dalio's all-weather portfolio might lag behind the general stock market during the good times. However, it clearly beats the general stock market during the bad times. Thus, the all-weather portfolio is an excellent choice for people who seek steady returns while minimizing downside risk. That's all for this video. If you found it informative, please give us a like and comment down below. Also, please consider subscribing to our channel. We have new videos every day about investing and personal finance. Thanks for watching.